Over the next decade, $38 trillion in savings will lose 30 to 40% of its purchasing power. This is not a prediction, it's a structured default already in motion. There are 5 covenants buried in the term sheet of every treasury bond, pension fund allocation, and retirement account you own. Most creditors don't know they signed them. Picture this. It's 2 a.m. in the Treasury's auction room. $9 trillion in government debt must roll over in the next 12 months. That's $27,000 per household. Foreign buyers are stepping back. China has dumped $300 billion. The Fed's balance sheet sits at $8.5 trillion, still bloated from emergency monetization. Someone has to absorb this debt. That someone is you. Your pension, your savings account, your retirement fund. You're the captive creditor. And the terms you agreed to? Negative real returns locked in for a decade. This is Covenant 1, the rollover obligation. The question isn't whether this default happens. It's whether you understand the 4 other covenants before your purchasing power is cut in half. This is Covenant 1 of 5, the obligation that makes everything else possible. Here's why this matters to you. Every time the government can't refinance its debt at auction, mortgage rates spike, because Treasury yields control all borrowing costs in the economy. Your 30-year fix jumps from 7% to 9%. That's $400 more per month on a median-priced home. The first covenant is the rollover obligation, the requirement that the U.S. Treasury continuously auction new debt to repay maturing bonds, creating a perpetual refinancing cycle that cannot stop without triggering sovereign default. Britain faced this exact problem in 1947. The Treasury held £650 million in maturing war bonds, while reserves stood at £450 million. They had to refinance or default. The solution? Forced domestic institutions to buy new gilts at capped rates while inflation eroded the real value. Same playbook and different currency. Here's how the rollover mechanism works. Imagine a revolving credit facility that never pays down principal. Every month, $750 billion in Treasury securities mature. The government doesn't have $750 billion in cash, so they auction new bonds to pay off the old ones. This has worked for decades because there was always a bid. But here's what changed. Foreign central banks, who used to absorb 30% of every auction, are now net sellers. China has reduced holdings by $300 billion since the peak. Japan is dumping treasuries to defend the yen. The Gulf states are diversifying into yuan and gold. The bid is thinning. The Treasury announces an auction. Say, $50 billion in 10-year notes. Primary dealers, Goldman, JP Morgan, Citi, are legally obligated to bid. They can't walk away. This is their covenant, guaranteed liquidity provision in exchange for their dealer license. But dealers don't hold this debt forever. They warehouse it for days, maybe weeks, then offload to end buyers. Pension funds, insurance companies, foreign central banks, retail investors. If those end buyers don't show up, dealers get stuck holding inventory they don't want. Their balance sheets bloat. They demand higher yields to compensate for the risk. When foreign buyers were absorbing $500 billion annually, this worked. Now they're selling $200 billion per year. That's a $700 billion swing in demand. Someone has to fill it. That someone is the Federal Reserve, which buys treasuries through emergency monetization, what they call quantitative easing. And that creates the second covenant, the inflation tax. Here's what this means for you. $9 trillion in debt matures in the next 12 months. That's $27,000 per U.S. household needing refinancing. If just 10% of that fails to refinance cleanly, Treasury yields spike 100 basis points. The 10-year goes from 4.5% to 5.5%. Mortgage rates follow. Your 7% fixed becomes 8%. Your monthly payment on a $400,000 home rises $300. The housing market freezes. Your home value drops 20% in 6 months. When Treasury yields rise, corporate borrowing costs follow. Companies with $10 trillion in maturing debt face refinancing at 7 to 8% instead of 4 to 5%. Profit margins compress, layoffs begin. Unemployment ticks up. Consumer spending falls. Tax revenues decline, making the deficit worse, requiring even more borrowing. This is the doom loop embedded in Covenant 1. You might be thinking, but the U.S. has never defaulted. Treasuries are the safest asset in the world. This refinancing has worked for 80 years. Why would it break now? Here's the problem with that assumption. It worked when the US was a net creditor, running trade surpluses, with debt at 30% of GDP. Now debt is 130% of GDP and rising. It worked when foreign buyers were accumulating dollar reserves to fund export-driven growth. Now they're diversifying away. It worked when the Fed could credibly promise 2% inflation. Now inflation is structurally higher due to deglobalization, energy transition costs, and deficit spending that won't stop. The mechanism didn't break yet because the Fed stepped in with $5 trillion in monetization. But that cure, printing money to buy bonds, is what creates the next covenant, the inflation tax. The rollover obligation is locked in. The question is who pays for it? Foreign creditors who can exit, or domestic creditors who can't. And that's Covenant 2. This is Covenant 2, the mechanism that transfers wealth from creditors to debtors without a single vote in Congress. Here's why this matters to you. Inflation at 7% while your savings account pays 0.5% means you lose $4,200 per year on a $60,000 balance. That's a stealth tax larger than your federal income tax bill, and it compounds. After 10 years, your $60,000 has the purchasing power of $31,000. The second covenant is the inflation tax, the policy of running inflation above bond yields to reduce the real value of debt, shifting purchasing power from creditors, savers, retirees, bondholders, to the debtor, the government. Britain ran this exact playbook from the 1950s through the 1970s. Gilts were capped at 2.5% by government decree, while inflation ran 5 to 15%. Real returns negative for 25 consecutive years. Bondholders lost 40% of purchasing power. The government called it financial stability. Creditors called it theft. But they had no exit. Capital controls prevented flight. Think of it as a slow-motion haircut. In a traditional default, the government says, "We're only paying you 60 cents on the dollar." Creditors riot. Markets crash. Politicians lose elections. But with the inflation tax, the government keeps paying 100 cents. It's just that those 100 cents buy what 60 cents used to buy. Same outcome, different optics. And this time, the government blames supply chains and corporate greed instead of its own monetary policy. Here's the tool. The Federal Reserve targets 2% inflation. That's the stated goal. But look at what they tolerate. From 2021 to 2024, CPI ran 7%, 6%, 3.4%. The Fed's response? They raised rates, yes, but not enough to bring real yields positive. The 10-year Treasury sits at 4.5%, while CPI runs 3.5%. That's a real return of 1%, barely positive, and that's before taxes. After a 25% tax on interest income, your real after-tax return is 0.1%. You're treading water while inflation erodes the principal. This is called financial repression, the policy of keeping interest rates below the inflation rate to reduce government debt burdens. Why does the Fed tolerate this? Because the alternative is worse. If they raised rates to 7% to match inflation, debt service costs would explode. Interest on $36 trillion at 7% is $2.5 trillion annually, more than half of all tax revenue. The government would face a choice: cut entitlements, raise taxes, or default. So instead, they keep rates artificially low and let inflation do the work. Here's what this means for you. Your grocery bill was $100 per week in 2019. It's $135 now. By 2029, it'll be $180. Your rent was $1,500. It's $2,100 now. In 5 years, $2,800. Your car insurance was $1,200 annually. Now $1,800. Soon, $2,400. These aren't isolated price shocks. This is systematic purchasing power destruction. And your wage gains? They're lagging inflation by 2 to 3 percentage points per year. You're getting poorer in real terms while your nominal paycheck looks like it's rising. When the inflation tax works, it creates a wealth transfer from creditors to debtors. Retirees on fixed incomes lose purchasing power. Savers see their nest eggs shrink. But homeowners with fixed-rate mortgages win. They're repaying debt with cheaper dollars. This is politically intentional. The government is the biggest debtor. Homeowners vote. Retirees and savers are a smaller, less organized constituency. The inflation tax rewards the majority, debtors, at the expense of the minority, creditors. This is why it persists. You might be thinking, but inflation is coming down. CPI was 9% in 2022, now it's 3.5%. The Fed is winning. This isn't permanent. Here's the problem with that assumption. Inflation fell from 9% to 3.5% because of base effects and energy price normalization. But the structural drivers haven't changed. $2 trillion deficits. Deglobalization pushing up manufacturing costs. Green energy transition requiring $3 trillion in subsidies. On a demographic aging, increasing healthcare and social security spending. The Fed's 2% target is aspirational. The new normal is 3 to 4% inflation with bond yields capped at 4 to 5%. That's negative real returns for a decade. This isn't a shock, it's the new equilibrium. The inflation tax is locked in. The question is whether you can escape it by selling your bonds. And that brings us to Covenant 3, the reason you can't. This is Covenant 3, the most critical mechanism. This is why the system works. This is why creditors can't escape. Here's why this matters to you. Your pension fund is legally required to hold 60 to 70% in investment-grade bonds. That's $3.5 trillion locked into treasuries earning 4%, while inflation runs 6 to 7%. Your retirement checks will buy 30% less in a decade. And the fund manager can't sell without violating fiduciary rules. The third covenant is the captive creditor trap, a web of regulations that force pensions, banks, insurers, and money market funds to hold treasury securities regardless of returns, creating guaranteed demand that allows the government to issue debt at below market rates. Britain deployed this exact trap in the 1950s. Sterling balances. Commonwealth nations held £3.5 billion in frozen reserves in London, legally required to keep funds in sterling-denominated gilts. When they tried to withdraw, the UK imposed capital controls. Exit required treasury permission, which was denied. They were locked in while inflation destroyed value. India lost 40% of its reserves in real terms over 15 years. Picture the boardroom of a state pension fund. Assets under management, $200 billion. Beneficiaries, 2 million teachers, firefighters, police. The portfolio allocation is set by statute. 65% bonds, 30% equities, 5% alternatives. The bond allocation must be investment grade, meaning treasuries, agencies, AAA-rated corporates. The fund manager sees the problem. Treasuries yield 4.5%. Inflation is 6%. Real return, negative 1.5%. The fund needs 7% annually to meet pension obligations. But the statute doesn't care about real returns. It cares about safety. So the manager buys treasuries. Every year, regardless of yield. Because that's the covenant. Here's the regulatory cage that locks them in. Basel III capital rules. Banks must hold government bonds as Tier 1 capital, meaning treasuries count as zero-risk assets. A bank can hold $100 billion in treasuries with no capital charge. But $100 billion in corporate loans requires $8 billion in equity capital. So banks choose treasuries. ERISA fiduciary standards. That's the Employee Retirement Income Security Act. Pension managers must invest in prudent assets. Courts have ruled that treasuries are inherently prudent, even at negative real yields. A manager who avoids treasuries and loses money can be sued for imprudence. A manager who holds treasuries and loses purchasing power cannot. So they hold treasuries, insurance reserve requirements. State regulators mandate that life insurers hold 70 to 80% of reserves in investment-grade bonds. Treasuries are the largest liquid market. So $2 trillion in insurance assets flow into treasuries regardless of yield. Money market fund reform. SEC Rule 2A7. Funds can only invest in assets maturing in under 13 months with minimal credit risk. That's treasury bills. $6 trillion in money market assets locked into short-term treasuries at whatever yield the government offers. This is the captive creditor base. They cannot exit. They cannot diversify. They must buy treasuries. And the government knows this. Here's what this means for you. CalPERS, the largest U.S. pension fund, holds $140 billion in bonds earning 4%. Inflation runs 6%. That's $2.8 billion in annual loss of purchasing power. Over 10 years, $28 billion evaporates. CalPERS has 2 million beneficiaries. That's $14,000 per person in lost retirement income. And CalPERS can't change this without breaking state law. Your pension is locked into a depreciating asset by statute. When pensions lose purchasing power, benefits get cut or contributions rise. State governments face a choice: increase pension contributions, raise taxes; cut benefits, violate promises; or underfund pensions, create future crisis. Most choose underfunding. Result: pension funding ratios drop from 80% to 60%. More retirees, fewer workers contributing, lower returns. The insolvency clock ticks faster. The political solution will be another bailout, funded by more treasury issuance, which creates more captive demand. This is the self-reinforcing loop. You might be thinking, but pension funds can lobby to change the rules. They can diversify into stocks, real estate, private equity. They're not truly captive. Here's the problem with that assumption. Lobbying takes years. Meanwhile, the losses compound daily. And even if they win more flexibility, they can't dump treasuries en masse, because that would trigger Covenant 5, the exit guillotine. If CalPERS tried to sell $50 billion in treasuries to buy real estate, bond prices would crater, locking in capital losses. Other pensions would panic and sell, triggering a death spiral. So they're trapped by coordination failure. The first one out loses the least. The last one out loses everything. No one moves. This is why the captive creditor trap works. Now we have to address the elephant in the room. If a major pension fund successfully lobbies to remove treasury mandates and publicly announces a shift to real assets, it could trigger coordinated flight by other captive creditors. This is the only mechanism that could break Covenant 3, but it requires political will, which is absent because the government controls the regulatory apparatus. The captive creditor trap ensures demand. The inflation tax transfers wealth. But there's still one more step. The government must devalue the currency to make the debt cheaper to repay. That's Covenant 4. This is Covenant 4, the mechanism that makes the inflation tax global, forcing devaluation onto creditors everywhere. Here's why this matters to you. If the dollar loses 40% of its value over the next decade, everything you import costs 67% more. Your iPhone goes from $1,000 to $1,670. Your Honda goes from $35,000 to $58,000. Your prescription drugs double in price. Your living standard drops, not because you're poorer, but because your currency is. The fourth covenant is the devaluation lockstep. The policy of allowing the dollar to depreciate against real assets, gold, commodities, foreign currencies, to reduce the real cost of debt repayment, transferring purchasing power from dollar holders to the government. Britain executed this twice. Sterling devalued 30% against the dollar in 1949 and 14% in 1967 to reduce real debt burden. Bondholders holding gilts lost purchasing power twice. Import costs spiked, living standards fell, but nominal debt payments continued. The government called it currency adjustment. Creditors called it default. Think of it this way. The US owes $36 trillion. If the dollar loses half its value, the debt is effectively $18 trillion in real terms. So the government still pays $36 trillion in nominal dollars, so there's no default announcement. But those dollars buy half as much. Imports cost twice as much. Savings lose half their purchasing power. Living standards fall. This is the currency devaluation strategy. It worked for Britain. It's working for the US now. Here's the proof. Gold was $275 per ounce in 2000. It's $2,000 now. That's not gold appreciating. That's the dollar depreciating. The dollar has lost 86% of its value relative to gold in 25 years. Oil was $20 per barrel in 2000. It's $80 now. 4 times increase. Copper was 80 cents per pound, now $4 per pound. 5 times. The CPI says inflation averaged 2.5% annually over this period, implying prices should have risen 80%. But commodities rose 300 to 500%. The gap? Currency debasement. The mechanism is simple. The Federal Reserve expands the money supply. M2, that's broad money, was $4.6 trillion in 2000. It's $21 trillion now. That's a 350% increase. More dollars chasing the same goods means each dollar is worth less. This is monetary devaluation. Here's what this means for you. You're not just losing purchasing power to inflation. You're losing it to currency debasement. Your $100,000 in savings in 2000 could buy a median home. That same $100,000 in 2025 buys half a median home. In 2035, it'll buy a quarter. This isn't price inflation. This is currency destruction, and it's accelerating. When the dollar devalues, foreign creditors panic. China holds $800 billion in treasuries. If the dollar drops 40%, their $800 billion is worth $480 billion in real terms. So they sell. Japan, Gulf states, Korea, they all reduce holdings. This accelerates dollar weakness, creating a feedback loop. The weaker the dollar, the faster foreign creditors exit. The faster they exit, the weaker the dollar. This is the devaluation spiral, you might be thinking, but the dollar is still the reserve currency. It's 58% of global FX reserves. No alternative exists. The dollar can't collapse. Here's the problem with that assumption. Reserve status doesn't prevent devaluation, it just slows it. The dollar's share was 72% in 1999. It's 58% now. That's a 20% decline in 25 years. BRICS nations are building alternative payment systems. China and Saudi Arabia are settling oil in yuan. Gold reserves are rising globally. The dollar's monopoly is eroding. Slowly, yes, but irreversibly. And when reserve status breaks, the devaluation accelerates. Ask Britain. Sterling went from 87% of reserves in 1945 to 3% in 1976. 30 years. That's the timeline. The devaluation lockstep is inevitable. The question is whether you can exit before it hits. And that's where Covenant 5 comes in, the guillotine that waits for anyone who tries to leave. This is Covenant 5, the final trap. This is why creditors don't escape even when they see the losses coming. Here's why this matters to you. If you try to sell your treasury bonds to escape negative real yields, you trigger capital losses. A $100,000 bond portfolio bought at 4% yields loses 20% of its value if yields rise to 5%. That's $20,000 gone instantly. Plus, you owe capital gains tax on any phantom appreciation. You're trapped. The fifth covenant is the exit guillotine, the mechanism that penalizes creditors who try to sell bonds before maturity, locking in capital losses as bond prices fall when interest rates rise, ensuring that exit is as costly as staying. Britain saw this in the 1960s. Investors tried to sell gilts as inflation accelerated. Bond prices collapsed. A gilt bought at 100 in 1950 traded at 60 in 1970. Sellers locked in 40% losses. Those who held suffered slow erosion. Those who sold suffered instant losses. Either way, creditors lost. Exit was punished as severely as staying. Picture a pension fund manager in 2023. Portfolio, $50 billion in 10-year treasuries yielding 3%, purchased in 2021. Inflation spikes to 7%. The Fed raises rates. Yet new 10-year treasuries now yield 5%. What happens to the old bonds yielding 3%? Their price collapses. Why would anyone buy a bond yielding 3% when new bonds yield 5%? To match the 5% yield, the price of the 3% bond must drop. The math. A bond yielding 3% must trade at 80 cents on the dollar to match a 5% yield on a new bond at par. That's a 20% capital loss. Here's how the exit guillotine works. Bond prices and yields move inversely. When yields rise, prices fall. A 1% increase in yields causes a 7 to 10% price decline on a 10-year bond. That's duration effect. In 2022 to 2023, yields jumped from 1.5% to 4.5%. That's a 3% increase. Bond prices fell 25 to 30%. Pension funds, banks, and insurance companies holding $20 trillion in bonds saw $5 trillion in unrealized losses. Unrealized, meaning the loss exists on paper, but crystallizes only when they sell. So they don't sell. They hold to maturity, collecting 3 to 4% coupons, while inflation erodes value at 6 to 7%. They lose purchasing power annually instead of crystallizing a capital loss immediately. This is the choice. die slowly or die fast. Either way, the creditor loses. Here's what this means for you. Silicon Valley Bank failed in 2023 with $120 billion in assets because they held long-duration treasuries yielding 1.5%. When rates spiked to 4.5%, bond values collapsed. Depositors withdrew cash. The bank had to sell bonds at a loss to meet withdrawals. Losses wiped out capital. The FDIC seized the bank. Your deposits were insured, but the lesson is clear. Even safe treasuries can destroy balance sheets when the exit guillotine falls. When one institution tries to exit, others panic. If CalPERS announced it's selling $50 billion in treasuries to shift into real assets, the market would price in the selling pressure. Bond prices would fall before CalPERS even executes. Other pensions, seeing prices drop, would rush to sell first. This creates a stampede. Treasury yields spike. More unrealized losses materialize. Banks, insurers, pension funds all face insolvency simultaneously. This is why no one exits, because coordination failure guarantees mutual destruction. You might be thinking, but the Fed can intervene. They can buy bonds to stabilize prices. They did it in 2020. They'll do it again. Here's the problem with that assumption. Fed intervention in 2020 worked because inflation was low. The Fed could print $5 trillion without triggering runaway price increases. But now, inflation is structurally higher. If the Fed buys another $5 trillion to support bond prices, inflation reignites. CPI goes back to 8 to 10%. Real yields turn even more negative. The inflation tax accelerates, so the Fed faces a choice. Let bond prices fall and trigger bank failures, or print money and reignite inflation. Either way, creditors lose. This is the trap. Bottom line, if foreign central banks simultaneously liquidate $2 trillion or more in treasuries, the Fed cannot absorb that volume without hyperinflation. This is the systemic breakpoint, but it requires coordinated action, which geopolitics currently prevents. China, Japan, and Gulf states have conflicting incentives. As long as they remain uncoordinated, the exit guillotine holds. Those are the 5 covenants. Here's why they won't break and why your savings will. Same room, same screen, different numbers. The rollover obligation creates the need. The inflation tax executes the haircut. The captive creditor trap locks in demand. The devaluation lockstep reduces real debt burden. The exit guillotine punishes escape. This is not a conspiracy. It's a policy framework executed in plain sight. Britain did it 1945 to 1976. The US is doing it now. The precedent is documented. The mechanism is operational. Your savings, your pension, your purchasing power, they're the collateral in a restructuring you never agreed to. The covenants are binding. The losses are inevitable. The default is silent, but it's happening.